Welcome to Yahoo Finance Live. I'm Julie Hyman, along with Josh Lipton here at the New York Stock Exchange. Here are your big three at 3, your big 3 stories to watch at 3 p.m. We start with the market sell-off, of course, accelerating on Wall Street. Treasury yields hitting fresh 16-year highs. The 10-year now hovering around close to 4.8%. The 30-year now near 5% as well. The moves are rattling investors, with the Dow now slumping the most since March, off by more than 450 points. We'll be tracking all the market action in this final hour of trading.
And the trial of SBF jury selection is now underway in the criminal trial against Sam Bankman-Fried, the face of the crypto boom and collapse. Bankman-Fried faces charges of money laundering, to all of which he has pleaded not guilty. We'll be breaking down the trial and its implications for the crypto industry.
And the streaming wars heat up. Warner Brothers Discovery raising the price of its ad-free Discovery Plus subscription by $2 to $8.99 a month. That change effective today. Plus, Netflix reportedly considering raising prices on its ad-free service. That's according to the Wall Street Journal. We'll delve into what the changes mean for investors and customers. But time now for a check on the markets and the big slump that we are seeing across the board here in stocks. We've got the Dow trading off right now by about 1.4%. That's a 460-point decline. Could be on track for its biggest one-day percentage decline since March. The S&P 500 off 1.5%, and the Nasdaq down by 2% right now. All of this on the back of what's happening in the bond market. The 10-year and 30-year Treasury yields moving to their highest levels since 2007. And this move today has been huge, right? We've got an 11 basis point increase in that 10-year yield, 13 basis points on the longer end of the curve. It is proving to be very problematic for equity investors.
Yeah, I woke up this morning, Julie, early, as I know you do, and it seemed kind of relatively calm, cool, and collected. I even saw some green on the screen. And then, though, another trading day, another day of surging yields. The JOLTS data we got, I think, playing some role there, but another day of these yields popping and stocks dropping. And I think in part it's just the speed of the sell-off in the bond market that people are reacting to.
Yeah, the speed here on top of what has already been a monster move in treasuries, right? You sort of had that move to 4.5%, and then things kind of went sideways for a while. And now another big move coming on the back of that. The latest data that we got was the JOLTS report, right? The job openings survey that came out earlier today. The number of open positions rising to 9.61 million. That was higher than estimated. So what does this imply? Well, it implies that maybe the Fed is still going to have to make more moves to get the job market and therefore inflation under control. So if you look at the CME FedWatch tool today and Fed funds futures and what they're implying, the odds are going up that indeed the Fed is going to have to raise rates another time at its November meeting. And that move, that increase, really happening over the course of the day as people are watching those bond yields.
Yeah, another reason for the sell-off that I thought was interesting was Ed Yardeni, very well-known economist and strategist. When he speaks, people tend to listen. And he was saying that he thinks what's motivating and moving the bond market now could be changing. He wrote to his clients this morning, the worry is that the escalating federal budget deficit will create more supply of bonds than demand can meet. So he's saying the focus of the bond market could be kind of changing here from, let's say, central bankers to more fiscal policymakers.
Yeah, I mean, and just to get a little wonky for a minute, there is increasing attention now on the weekly bond auctions and whether there is demand for those treasuries, to your point. Will there be demand sopping up all of that supply that's out there? That's something that the markets are watching very closely here to see where yields are going to be going.
Right, those are going to require perhaps higher yields just to clear that market.
Exactly.
All right, well, let's move on to our guests today. We have a couple of them to go through. One is Kevin Mon. Julie, can you take this one? Kevin Mon.
Yes, exactly. We're going to be talking to Greg Dacco and Kevin Mon right now. EY Chief Economist Greg Dacco, Kevin Mon, Hennigan & Walsh Chief Investment Officer. Let's dive right into it, guys. I think, we're a little head spun here because of what's going on in the markets here today. It's good to see you guys. Greg, I'm going to go to you first on what we were just talking about. That is the reaction that we're seeing to the JOLTS numbers today and this thinking that, we're going to maybe have to see the Fed move again to tighten, in this market.
Yeah, I would take a slightly different approach to the recent data. If you look at the JOLTS
Greg,
report,
we cannot hear you for some reason.
Can you hear me now?
Hopefully we can get that sorted out. No, we can't hear you now. Must be something on our end. Kevin, do we have you?
Yes, can you hear me?
Okay. I'm not hearing anybody on our
we'll
end.
fix the audio.
Okay. So we are going to take a quick break. We're going to try and get everything sorted out, and then we're going to come right back. Stay with us.
As stocks feel the pressure amid rising yields, the number of job openings in the U.S. saw an increase in August, hitting its highest level since May, the latest raising questions of whether the job market is cooling fast enough to appease the Fed. Here to discuss all the market action and more, we have EY Chief Economist Greg Dacko, along with Kevin Mon, Hannian and Walsh Chief Investment Officer. Kevin, let me start with you. Just this backup in yields we're seeing. What do you think is motivating that, Kevin? Is that Fed messaging? Is it issuance? Is it fiscal challenges creeping up on us?
I believe we've remained in an environment where good economic news translates into bad market results. Why is that? Because it increases the likelihood of the Fed moving again this year. And if, in fact, they move by another 25 basis points, I believe they risk pushing the economy from a slowdown period, which they're forecasting is going to take place over the course of the next 2 years, into a recessionary period. Why do I think that? Just consider these stats right now. We have an over-leveraged U.S. consumer, a consumer that accounts for 70% of economic growth in our country. If, in fact, they move by another 25 basis points, well, those consumers have to pay off their credit card balances, which are now over $1 trillion, and credit card interest rates are above 24%. We also seen the pace of delinquency start to increase at their highest pace in over 10 years. If the consumer shifts to having to service their debt away from consumer spending, the economy will slow down further. Rates will likely stay higher for longer, as the Fed has been suggesting. But if this economy slows down too much, then we might be talking about interest rate cuts towards the second half of next year, as opposed to interest rate increases as we are during the last quarter of this year.
And Kevin, just to push on that, some would say, listen, there are some storm clouds brewing for the consumer. You're right, but they might argue back. Listen, the labor market is sturdy, low unemployment, sub 4%, strong wage gains. How do you think about that?
And the labor market is what has kept this economy going thus far throughout the 525 basis points in rate hikes that we've seen to date. But how much longer can the labor market remain as strong as it is? Even by the Fed's own estimates, according to their summary of economic projections, they believe the unemployment rate is going to increase to 4.1% by the end of this year. They also believe that economic growth is going to slow to 1.5% by the end of next year. Still growing, but slowing. How are they going to justify keeping rates as high as they are if, in fact, the economy slows down further than that? They may have to live with inflation above 2% as opposed to risking pushing the economy into a deeper or more protracted recession.
All right, Greg, let's get you in here on this because there's a key word in what Kevin was saying, and that word is if. If the estimates prove correct. Because guess what? An awful lot of the estimates have not proven to be correct thus far this year,
true.
Greg. So, I mean, look, Greg, look at the JOLTS report today. What does that tell you, and what does it tell you about what we're going to hear on Friday from the Labor Department report?
I think we have to be careful with any report. The JOLTS report in particular, given the very low response rates, we did see that openings rose, but I would tend to look at hirings and the quits rate as better indicators of underlying strength in the labor market. Both of these are at or below their pre-pandemic levels. So there is an ongoing easing of labor market trends. I think what we're seeing in the markets is really an adaptation to this higher cost of capital environment where the Fed is unlikely to cut rates in the near future. Yes, the odds of another rate increase have increased over the last few days, but I think the Fed is really done with its tightening cycle. We've heard from Williams, we've heard from Barr in terms of maintaining the current restrictive stance of monetary policy. That means that they're going to stay at these high rates for the foreseeable future. I think that's what we're starting to see in terms of market pricing, along with fiscal sustainability concerns. That is really the market paradigm that is shifting towards this higher cost of capital environment.
So if that's the case, Greg, what does that imply for Treasury yields? Are we going to see 5% right around the corner for the 10-year? And are we then going to see that sustained level of high rates for how long?
Well, I think for the foreseeable future is really the answer. We're going to be in this higher interest rate environment for the foreseeable future. We're not going to see the type of rapid rate cuts that the Fed has proceeded with in times of economic slowdowns and prior times of economic slowdowns, especially as long as inflation remains too high for comfort. We know the Fed is adamant to getting inflation back down towards its target, towards its 2% target, and it's going to be willing to tolerate some pain in the form of slower consumer spending, slower business investment, and slower employment growth. As was said earlier, this is going to be a key element of the outlook. If we start to see a degradation in the state of the labor market, that is going to lead to a faster slowdown in consumer spending growth and a faster slowdown in inflation. Let's not forget one key point here. The tightening that we're seeing on the financial markets front in terms of financial conditions is doing some of the Fed's job. So the more tightening we get, especially on the long end of the interest rate curve, the less the Fed has to do in terms of tightening monetary policy. That's very important to keep in mind as we look on the horizon into 2024.
And Kevin, on a day like this, I think a lot of investors tune in. They want to know where they should be putting money to work. You're a CIO, so just given your view of the economy, Kevin, of the Fed, where do you see opportunity?
It really does depend, Josh, on what the investment time frame is for that investor, what their goals and objectives are, and of course, what their risk tolerance is. If their investment time frame is the next 6 months, perhaps they shouldn't even be in the market altogether, and they should be in a money market or a CD investment or a short-term treasury. But if their investment timeframes is 5, 10, 15, 20 years, that they want to fund their retirement or put their kids through school, well, looking out over the next 2 to 3 years, I think we would all agree that rates are going to be lower. The Fed has forecasted 50 basis points in cuts next year, another 125 in 2025. and another 100 basis points in cuts, at least according to their dot plot chart, in 2026. So rates should be roughly 3% lower over the course of the next 3 years. Inflation should be lower, and economic growth should start to rebound. If the economy starts to grow again in the next 3 years, inflation is lower and yields are lower. That creates opportunities in stocks and bonds. There's a number of sectors that we like right now to ride out this economic slowdowns, such as healthcare, staples, and even technology. But look for quality companies that have strong balance sheets, that pay a dividend to help weather the storm, but also to help you to participate in the ultimate recovery that's going to come down the road once the Fed starts cutting rates, which unfortunately may not be till the second half of next year.
So what does that imply for equities then, Kevin, in the near term, right? In the next 6 to 12 months, if yields remain at or near these levels?
It's going to be a very volatile next 6-month period, in my view. We also have to remember, Jules, that next year starts a pretty important election cycle, too. So now we're adding political risk to the additional risks that are already in place in the markets. We're going to stay tuned to what happens with the Federal Reserve. What do they say or what don't they say? Third quarter earnings. Will this be the third consecutive quarter of negative year-over-year earnings growth, or do we start to grow out of that again? Does the labor market start to feel the pen? And this all-important holiday shopping season, I don't think it's going to be as robust as some are suggesting, because the consumer's going to have to start reining in their spending because they no longer can dip into their personal savings and have too much on their credit cards already. But if you can stay defensive, stay in quality companies, maintain your investment-grade bond allocations, and not try and time the market by going to cash and coming back in when you think the coast is clear, I believe there are opportunities in the market, and they may be trading at attractive valuations pretty soon to add allocations to certain areas of the market, such as the ones I discussed earlier, Jules.
Guys, thanks so much for your time. Thanks for your patience. Kevin Mon and Greg Dacco. Good to see you guys.
My pleasure.
We have some late-breaking news here. Novavax's updated COVID vaccine approved by the Food and Drug Administration. The shot still needs an updated recommendation from the Centers for Disease Control, but the company says that should be happening, quote, imminently. And once that recommendation comes, the vaccine will be available for patients at pharmacies, doctors' offices, and distribution centers. This news coming just weeks after Pfizer and Moderna's updated vaccines became available. Shares of Novavax up about 12.5% on the news. And Novavax has said it is ready to ship 6 million doses of this vaccine once it does get the CDC approval as well.
Yeah, it'll be interesting because the rollout, though, of some rivals has been kind of bumpy, right? I mean, we saw the government give the green light to Pfizer, Moderna, but you've heard these issues of not just insurance issues, but availability issues, too.
Right, exactly. Yeah. And Novavax has been viewed sort of as an also-ran in some quarters because it was so late to the game to get approval for its vaccine, which of course uses a different type of biotechnology than do the mRNA vaccines. It's more of a traditional formulation, if you will. So it'll be interesting to see what the uptake is of Novavax versus, even if you can't find the others, will people be as willing to try this one? I think that remains an open question. But for, a single product company, like so many of these, the smaller players in this industry are, there's a lot riding on that uptake for the likes of a Novavax.
On a down day, investors like the news. Look at that, ticking up about 13%.
Yeah. Well, let's get to some other trending tickers that we are watching right now. The automakers on the list, GM and Toyota, both posting double-digit sales gains in the third quarter. GM and its dealers delivering more than 674,000 vehicles in the U.S. That's up 21% year over year. Toyota, meantime, reporting sales over 590,000 vehicles. That's up 12% from the prior year. This is not some of the automakers report on this timeline. We just heard deliveries from Tesla yesterday. Ford, we don't hear from for this particular metric on this timeline, but it gives you an idea kind of what's going on here. But the stocks are down.
Yeah, I mean, I think it's interesting for investors right now. You're kind of concentrating on what's next, right? So if you're in these names, you're thinking about how the UAW strike doesn't seem like that's ending anytime soon, right? Wages, wage tiers, pensions. So to the extent that keeps going on at some point, impacting production perhaps. And of course, as we were just talking about, higher borrowing costs. How does that all weigh on demand for vehicles looking ahead?
Right. If my finance, it's like we keep talking about with mortgages, how much that payment has gone up for the same price of home. Well, of course, the same goes for auto prices. Now, auto prices are a little more variable, right? But at the same time, if I'm financing an auto purchase,
Yeah.
that's going up. My financing costs are going up.
For sure, and I think that's what you see investors reacting
Yeah.
to there. Trading has been halted for Molson Coors as we get some headlines from the company's strategy day as well. This was interesting name, of course, Julio. It's up actually about 20% so far this year. And one theme of this, of course, has been the problems plaguing Bud Light there, got caught up in a culture war. The extent to which perhaps Molson Coors, the question has been asked, is going to be able to capitalize on that dust-up.
Right, exactly. Now, again, these shares are halted, so we're not seeing reaction to this news as of yet. The company's strategy day saying its long-term net sales revenue growth should be in the low single digits, and its long-term underlying income before income taxes should be in the mid single digits, high single digit long-term underlying earnings per share growth as well. I believe this is mostly repeating targets that are already set. One other thing that we learned from the strategy day, got a little color on what we're going to see in the Super Bowl, apparently, or what kind of ads they're going to be coming out with. The NFL's J.J. Watt is going to be doing some new Miller Lite commercials. So that's part of it. They're going to boost their ad spending for the Coors Banquet line, which I think of as sort of a very old school. Maybe I guess it's coming back. And it's also, its theme for its Super Bowl ad is going to be made to chill.
Yeah, I mean, listen, the extent that they push in to the Super Bowl, that's interesting because traditionally you would think NFL and Bud Light.
Right.
So they're making moves.
Exactly. So
I will say though, this it's interesting. 20%, but about 70% of analysts, so the gross majority, are a hold on this name. They are on the sidelines. So not a lot of love on the street.
I mean, at this point in the day, it's likely it's just going to be halted through the close. So we'll keep an eye on it and see if there's some after hours activity that would give us an indication as to how people are reacting to some of these headlines. We're also watching shares of Airbnb today. They are down by nearly 7%. That's after the stock was downgraded over at KeyBank. Analysts there attributing the move to easing travel demand, saying margins have likely peaked and revenue growth could slow. And there was an interesting interview with CEO Brian Chesky the other day in which he talked about some real fundamental issues at the company that he is trying to change amidst competition, amidst other issues like new regulations in New York that are going to make it much harder for people to rent out their properties as Airbnb.
And in fact, this analyst actually called out New York in that downgrade. So he goes to sector weight, which is basically a meh, right?
Yes.
But he actually called out New York City because he said restrictions here, Julie, and obviously when we think about New York City, popular destination for New Year's Eve, right? That could actually accentuate, he says, quarter-over-quarter decline. So that is a reason he moved to the sector weight there.
Yeah, I mean, kind of understand that ruling in New York City. If anybody who lives in lives or has ever lived in an apartment building in New York City, and you got like strangers coming in and out of the building, it's not something that buildings like that much.
Do you feel better about the move to New Jersey when you hear that?
Yeah.
All right, well, we are just getting started here on Yahoo Finance Live. Coming up, time to pay up. Meta has plans to charge Instagram and Facebook users in Europe for ad-free services, but could the U.S. be next? And shop till you drop. A new retail outlook predicts this holiday season will be a record for consumer spending. We'll break down how inflation might play into the numbers. And Chipotle is testing a machine that could build your bowl for you. Or will it skimp on the guac? Key question there. Key question. All that and more, of course, when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
As we head to the close, there is no abatement in the selling here. We've got the Nasdaq now down around 2.1%, near its lows of the session. The S&P up 1.5%. The Dow off 1.4% today. It's quite a broad-based sell-off as well that we are seeing for the major averages. Now, with this downdraft in stocks comes an uptick in volatility. Not surprisingly, the VIX at 20 here, above 20. This is the first time it has hit that measure since late May, as we see a reflection here of this increased volatility in stocks.
Stock market is down hard in today's trade, and bank stocks aren't having an easy time either. The XLF, that's the ETF that includes names like JP Morgan, Morgan Stanley, and Goldman Sachs, in the red as higher for longer interest rates weigh on that sector. Here with more on the bank stocks and where there might be opportunity for investors is Gerard Cassidy with RBC. Gerard, thank you for joining us.
You're very welcome, Josh.
So, Gerard, looking at the names here, it strikes me, year to date, Gerard, Goldman, Wells Fargo, Morgan Stanley, Citi, all in the red. JP Morgan is in the green year to date. But I'm wondering, when you look at the bank stocks, when you look at the sector, Gerard, what is it going to take? What is it going to be the catalyst that you think gets these names moving higher again?
I think the key catalyst that we are focused on, which was the catalyst for the last 4 tightening cycles, is when the Fed reaches the terminal rate for Fed funds. And if you think the Fed funds rate is at terminal rate today, meaning the Fed is not going to raise the Fed funds rate any longer in this tightening cycle, this is the time to own bank stocks. Historically, the best examples of this were 1994-95 and 2004 and 2006. And during those time periods, the banks bottomed out 3 to 6 months prior to the terminal rate being reached in February of 95 and June of 06. And the stocks did quite well after we reached the terminal rate. So the catalyst, Josh, it's going to be, when is the Fed finished raising the Fed funds rate?
So, Gerard, what do you think is being signaled here? I mean, if I look at a chart of the XLF as an example, right, it was at its lows for this year, at least, back in March. Did that then presage the terminal rate already being reached, or, do we still have to go through a bit of a process here?
Julie, it's a really good question. And if you look at some of the more bank-specific ETFs, they bottomed in May when First Republic failed. But that's been the monkey wrench or the curveball in the equation this year, is the 3 bank failures that we all witnessed. Of course, Silicon Valley started it in March with Signature Bank, and then followed by First Republic. And so we kind of threw it off kilter based upon those failures. But if we now have those failures behind us, we don't expect any other types of failures like that. And so if the Fed really is at terminal rate right now, the stocks are bottoming out. But here's the risk. The risk is they're not able to get inflation under control. And we're now sitting in March of 24, and they're still staring at a 4 to 5% inflation rate. And they have to take the Fed funds rate up north of 7% to bring it under control. That's the bear case for the banks. Now, that's not a consensus call, and we're not calling for that. But that's the long tail risk for the banks today.
What about the economy, Gerard? I'm interested. There's a lot of smart CEOs and economists. They come on Yahoo Finance and they'll say, listen, they think the Fed is going to stick this soft landing. Others have come on and said, reiterated that's actually pretty rare and tricky. But if there is a soft landing, Gerard, what would that mean for the stocks in your universe? What would it mean for the bank stocks in 2024?
Josh, it's the $64,000 question, and it is the critical question because banks are products of the economy. And it's always easy to say the current period is the most challenging, but the cross currents on the economy today are unprecedented. And the reason being is what they did to pull us out of the pandemic. As we all know, the Fed's balance sheet went from $4 trillion to almost $9 trillion during the pandemic. Our U.S. government's fiscal spending, in addition to the regular spending, they gave out almost $6 trillion of payments. So that stimulus to the economy has been really the big difference between prior periods. But if they are able to thread the needle on a soft landing, like Greenspan did in 1994-95, you go back to that period, once again, rates went up from 3 to 6% from February of 94 to February of 95. 1994 was a wreck for the bond market. Orange County, California, filed bankruptcy. You had the Mexico peso crisis. It was really bad. Stocks sold off hard, the bank stocks, in the second half of 94. But once it became apparent in 95 that we had what they called back then the Goldilocks economy or the soft landing, banks were up 55% in 95, best single sector in the market. And so next year, if we get the terminal rate now and a soft landing, bank stocks are going to be big winners next year because the relative valuations today are the lowest we've seen in decades.
Gerard, what if the terminal rate, though, just keeps on keeping on? What if we get this higher for longer scenario? And I know we haven't had the discussion for a little while about unrealized losses. In the wake of the collapse of those banks, that was a big topic of conversation. It sort of receded, but rates keep moving up and up and up. So I imagine there are going to be some questions for these banks coming once again on that topic.
You're absolutely right. Third quarter earnings calls, which start October 13th, what we refer to as AOCI, which is accumulated other comprehensive income, which is where the unrealized bond losses sit in the capital section of the balance sheet. It is definitely going to be discussed because those numbers went up. But the losses are not really deprecation of capital because, as you may know, those losses are duration timing losses, not credit losses. Most of the bond portfolios are government-backed securities or government securities, and it's a matter of timing. Many of the banks will tell you that, over the next 2 years, 20 to 40% of the unrealized bond losses burn off as those portfolios pay down. And so higher for longer at the front end of the curve, as you described, is very positive for the banks. Because what you're going to see happen is once we reach terminal rate, deposit rates stop going up around 5 to 6 months after terminal rate is reached. But the asset betas, the cash flows that are coming off the portfolios, are reinvested in securities and loans at higher yields, and margins start to widen. So if we're at the terminal rate today, the pressure on net interest margins probably goes away by the second quarter of next year, and you start seeing margin expansion in the second half of next year, which would be positive. But the long end of the curve, to your point, on the bond portfolios, that is something that we've got to watch, and it is distressing the way the 10-year is behaving.
And Gerard, I want to get you out on this. Earnings season is coming up. You've covered these bank stocks a long time. Do you have a top pick in the sector, Gerard, and why?
Yeah, going into this quarter, I think PNC is really the name to own, to go into it, partly due to the fact that the company is very well managed. When you look at their quarterly results, they're going to announce a meaningful cost savings program to give them positive operating leverage in 2024. They announced today that they purchased some of the loans from the old Signature Bank from the FDIC. That's going to be accretive to earnings by 10 cents a share starting in the fourth quarter, suggesting they got a very good price from the FDIC. Generally speaking, the bank buyers, the banks that buy assets from the FDIC generally received very attractive pricing, and they didn't give us the details. They will on the call. I expect that they bought these at a big discount to their par value, and the yields on them are very attractive. So going into the quarter and longer term, PNC would be the stock to own.
Gerard Cassidy, Capital Markets Managing Director to RBC. Thank you so much, Gerard. That was great. Appreciate it.
Anytime, Josh. Thank you.
Well, the trial of former FTX CEO Sam Bankman-Fried kicked off this morning in New York City with jury selection. SBF has pleaded not guilty to 7 counts of fraud and conspiracy pertaining to the downfall of the crypto platform. And if convicted, the maximum punishment could result in life in prison. For more on the trial and also its implications for the crypto industry more broadly is Kavita Gupta, Delta Blockchain Fund Partner. Kavita, it's good to see you. Thanks for being here. We had sort of the first wave of scrutiny on the industry when SBF was arrested, when the FTX collapsed, et cetera. Now there's going to be, I guess, another wave of scrutiny. How are people in the industry talking about this right now?
Sorry, I think to be very honest about it, within the industry, it has been so much talked about, so much discussed, moved on, because when the whole thing went down, it was a shock both outside the industry, inside the industry. The companies which had treasuries at FTX, the companies which has investments from them, had liquidity over there. They have already over a year has figured out a path, have charted away. But on the regulation side, on the trust in this industry and the overall encompassing movement, whether can you really trust, can you have a governance out here? I feel like this whole trial is going to set up the new rule book for us, and which honestly everyone in this industry is very excited about.
Kavita, you mentioned regulation here. We recently had Coinbase CEO Brian Armstrong on Yahoo Finance. He was talking about that and said that the U.S. is really falling behind here on the regulatory front. We don't have clear rules, he noted, on the books for how crypto should be regulated, how consumers should be protected. Do you expect that to be coming, Kavita, those new regulations?
Josh, I wish this could have happened 4 years, 3 years back, because this is one of the most technology industry, the evolution which started from US. And I completely agree with Brian. We have really, really fell behind. And France, UK, Dubai, Singapore, most of the other developing nations who really, or developed nations who really wants to be ahead in technology has way more clarity than US have. But at this point of time, unfortunately, this is my personal feeling that it has become too politicized. I don't see that SEC is really trying to put a clarity, because every time they have gone in front of the court, every time they have gone in front of the Senate, it feels like they themselves are very confused. This seems like more of a power play than to actually give a very clear direction of let's do this and let's not do this to really save the retail customers. I mean, FTX has been very close with the SEC chairman, Gary Gensler, and I don't think retail customers were really safe there.
Well, it seems like there's a lot of places that customers weren't safe, even besides FTX, right? There's a lot of questions about the likes of Binance and other exchanges. And, Bitcoin has been hovering around 30, but really below 30. It feels like we're sort of in a stall in the industry right now.
Yeah, and Julia, you're absolutely right, but I'll just split it into 2 questions. I think when it comes to the retail customer safety, the clear regulations from the governing body would really, really help, because then you know what's available, what's not available, and if people are ready to take risk, it's a known risk to take. And when it comes about Bitcoin or the overall crypto industry being under 30K, I would actually look at it that they have really put in a new bottom and have been resistance free on those prices from a long time. Bitcoin has hovered between 25 to 28K and continued to defend itself in that position, very close to gold at 28. Right. And I feel like they have really shown that the volatility of this asset class is actually not much out there. So this has been actually a very good stress test for the overall Bitcoin and ETH position.
Kavita, I have to ask, too, as you talk about, wanting more regulation to prevent some of the stuff like what happened with FTX. Sam Bankman-Fried's on trial. It was not, in fact, allegedly not legal what he was doing. And I think if you're somebody thinking about investing in crypto, at some point you have to wonder if there is something intrinsic to crypto that attracts this kind of behavior, regulation or no regulation.
Julie, what he did actually is a complete simple fraud, which is mixing two companies, which is an exchange and a hedge fund, a book which we have seen across any trading, hedge fund, Wall Street cases across the world. I think as a crypto, yes, people always think, oh, this is an unknown, this is a new, can there be a fraud? I mean, Hawala still exists maximum all over the world in cash, right? So you still have cash being one of the biggest sources of moving money illegally. But I think with crypto, what on the institutional adoption side we are missing is just the clear guideline. Like, these are the way you basically keep Chinese whispers or Chinese walls. This is the thing you cannot exercise. These are the products you can offer or cannot offer, or on governance side. But right now in US, at least it seems like a complete gray area. You just go and you apologize because there is no starting clear point.
And Kavita, another big headline that I know a lot of crypto fans are excited about is the spot Bitcoin ETF. Do you think that's coming, and if so, when?
I really hope it should have happened long time back because there's a lot of demand for it. But again, as I said, seems like today's SEC is very politicized, and I'm not sure when. Of course, we did see headlines that there has been a lot of pressure, even with the SEC chairman went in front of the Congress, in front of the Senate, that it should be done even before that appearance, which of course didn't happen. So I really hope it happens over next quarter. And if not, I am really looking forward to the elections next year to see if that brings in some change to the policies in this space.
We shall see. Kavita, thanks so much for joining us. Really appreciate your time. Kavita Gupta, Delta Blockchain Fund partner. Thank you.
Thank you.
Well, Instagram and Facebook are about to offer ad-free plans at a price that is, and only in parts of the world. Meta, which owns both platforms, is looking into subscription plans of around $14 a month for users in Europe, or $14 equivalent. It could be one way the company can work around tight European regulations that currently threaten its ability to show personalized ads without users' consent. Yahoo Finance tech editor Dan Howley joins us now with the details. So this is a report right now, but this would be a pretty big change.
It would be a huge change, Julian. I mean, this is something that Mark Zuckerberg has kind of gone against. This is almost antithetical to what you would think of Facebook. There's a famous hearing where he sat there and was asked, how does Facebook make money? And he said, we sell ads. So this would be kind of in response to the EU's new regulations regarding advertising. And so if users don't want to consent to having their personal information used to sell ads, they can get a version of Facebook or Instagram, whatever they end up using, by paying for it. So it seems odd. You can ask people whether or not they would pay for Twitter or X, and I think the answer for the most part from a lot of people was no. I got to imagine it's going to be the same for Facebook, Meta, Instagram. On the flip side, we have TikTok, which is also reportedly rolling out a version of its platform that would be ad-free, but this is just to get away from ads if you don't want to see them, and it would be $4.99 a month. But this is also outside of the U.S. So, it seems to be a going kind of movement on the part of social media to see how they can diversify revenue streams outside of the ad market. But, it's difficult to tell whether people would actually pay for it. There's plenty of cat videos on the internet. I don't know if I need to pay $4.99 a month for it.
You have cat videos at home, live in person with your kitties. Dan, this is interesting because it is a parallel with what we are seeing in streaming services, right? In terms of adding some of these paid ad tiers, right? But to your point, the way we consume that, not necessarily the way we consume social media. And, we don't, I guess, have that much insight into the uptake on the likes of an X and how many people are actually paying for that, right?
Yeah, and look, when it comes to something like, Netflix or Disney Plus, you're going to be invested in those shows. Yes, you'll pick up your phone and you'll scroll, whatever, just as a I don't know, a brain dump almost, when you're not paying full attention. But, usually when you're using social media, if you're not, I guess, a kid in high school or college, I just use it to pass the time. I'm riding the train, I'm just scrolling mindlessly. Nothing I consume on there matters to me at all. Where, when it comes to Netflix or Disney Plus, I want to know what's going on in those shows. So, that's why I'm paying for that. If I don't have Instagram or TikTok, I can go on Reddit, or I can just browse the web in general. So, yeah, it's really interesting to see these companies testing this idea. We'll just have to see if people actually want to pony up the cash. You can gather from my reaction, I would not pay for it. I'd pay for X right now only because I need to for work. But if I didn't have to, I would delete the app entirely.
All right, Dan Howie, thank you for all that. We appreciate it, sir. And coming up, Treasury yields climbing to the highest level since 2007, and the Fed says another rate hike may be on deck. Find out which stocks are being hit the hardest when we return. We're tracking the sell-off in markets today as Treasury yields climb to the highest level since 2007, and Fed speak indicates another rate hike is on the way. And some of the stocks that are being hit the hardest are utilities, Julie.
Until now. So, okay, of course, when I sort of zero in on the decline that's happening in utilities, they turn around. But take a look here at the Wi-Fi Interactive. It shows the sector action on the day, and we do have a broad-based sell-off. Except for one area of green.
Look at that.
The XLU, and it is indeed the utility. So here's what's been going on here, right? With this push-up that we've been seeing in bond yields, there are a couple of interest rate-sensitive groups that now have been really pulled downward in recent days, if not today. And that's the utilities, where we have seen up until today, really that underperformance. There's the year-to-date you're looking at, down 19%, but really the acceleration has come, call it in the past 2 months, since we have seen the 10-year breach 4%. So that's what we're seeing there. We have seen similar activity happen when you look at, for example, real estate stocks. Now, why are these two groups vulnerable when rates go higher? Two main reasons. One, these companies tend to have higher debt loads, so their debt servicing costs go up. And two, they have pretty high dividend yields. Both of them as a group, as these ETFs, are yielding northwards, well northwards of 3.3%. So that tends to attract investors. But when you're looking at a Treasury, a 10-year Treasury yielding 4.75 or a 30-year yielding closer to 5%, well, maybe you're opting for that to get that kind of yield back. But if you look at some of the individual movers here within some of the utility stocks, and there you're looking at the 5-day performance versus the S&P 500. This was something that was flagged by Bespoke Investment Group this morning, and basically saying that we are seeing the widest underperformance of utilities versus the S&P 500 going back to last October. Well, obviously the utilities bouncing a little bit in the wake of that call, which is interesting. And Bespoke did point out that these stocks had become oversold. If you look at the individual movers in today's session, one of them, and again, this is on the Wi-Fi Interactive, one of them that's coming back is NextEra Energy. This is a company that last week came out with a warning and saw a plunge in its shares. So, you know, it's coming back about 1% today, but it's still down pretty sharply here. And there was another strategist, Eric Johnston, over at Cantor Fitzgerald, who also was recommending calls on the XLU. So seeing a little bit of a bounce.
Yep.
For the moment.
For the moment.
We'll see if it lasts. Well, the rip higher in U.S. Treasury yields is reverberating throughout the bond and equity markets. We just described one way that it is doing that. Investors are piling into the higher for longer trade. But is the street piling into a lopsided trade once again, only to face a rug pull when the rubber meets the road? Yahoo Finance's Jared Blickley live from the floor of the New York Stock Exchange behind us with a special guest. Hey, Jared.
Hey there, Julie. I am sitting here with Alfonso Picatiello, proprietor, founder of the Macro Compass, and we've been talking about the bond market. You're in New York for a couple days. Really glad you're here. Do a lot of investor education, but we've had some disruptions in the bond market. Utilities just had their worst day since the pandemic. Is it really the worst time since pandemic? What's going on for us?
Well, I think the bond market is now testing this hypothesis, Jared, that the economy can handle higher interest rates, right? That's what they heard by the Fed. They revised their dot plot higher. They're trying to force the tightening and this higher for longer. And the bond market is going after it exactly as they did in late 2018, in late 2007, and in late 2000. When this bear steepening, when long end rates go higher, while nominal growth is slowing down, late in the cycle, it's a very dangerous cocktail for risk assets. So we're getting a bit more nervousness priced in markets today.
Does history provide any guide? What can a retail investor expect? Does it get worse before it gets better? How long do these episodes tend to last?
So generally, this late cycle bear steepening tends to last anywhere between 6 and 10 weeks. And right now, we've been going on for almost 10 already. So it's been a prolonged and very intense bear steepening, late cycle, as the economy is slowing down. History says the following: when this happens, and it used to happen in September 2018 last time, and in the last innings of 2007, it generally takes a few months until risk assets really crack badly. And it could be credit markets freezing, like at the end of 2018, or it could be a disaster like the Great Financial Crisis, or somewhere in the middle. But the sequence is bear steepening, pain gets priced through in equity and credit markets, and only after the pain has become acute, bond markets can rally. But this time, the main difference is inflation is at 4%. So can the Federal Reserve easily come in and rescue markets like they did in the end of 2018? I really doubt so.
Okay, so how does an investor play this? Because I believe, if I'm reading some of your latest missives correctly, that you believe that Wall Street hates bonds so much, it's a crowded trade perhaps, and that means whenever there's a crowded trade, it can unwind the opposite way. So suddenly we could find bonds outperforming. Is this your scenario? What are the triggers you might be looking for?
So look, the easiest way to play this market right now is to stay away from risk assets as much as you can, because the pain is going to get translated through the bond markets into equity markets. No stocks. Just stay away as much as you can for the time being. At some point, the pain is going to become acute. You're going to see capitulation in stock markets or in credit markets. We are not there yet, but today we're getting more nervous. Once that capitulation event happens, that's the point where bond markets start to become more attractive, because the pain is there. The damage has been done. So it's just a matter of time until the Fed has to cave in ultimately, and then bonds will deliver big positive returns. I think we're getting closer to that point, but we are not there yet. So for now, just play it safe, stay away from risk assets. Later on, bonds will be the asset to be in.
We got some big economic reports. We just got through PCE. That's on the inflation front. We have non-farm payrolls this Friday. Are you expecting any kind of trigger to come through the economic data, like a payroll report that just comes in too absolutely hot or too weak?
look, interestingly, at this point, if data comes in too hot, the bond market is going to go after it even more because it finds somehow a justification to go and chase higher yields and higher yields. The problem is if you do it at this point in the cycle, once you breach 5% interest rates, it starts to become really a burden for risk assets. On the other hand, if you get soft data, acceptably soft, the market could take a breather. Bond yields should stop going up and maybe equity markets can stabilize. The other flavor is an extremely weak labor market report that will confirm that the recession is coming closer, and again, it's no good for stocks. So however I cut and slice and dice it, too hot of a number, bad for stock, too cold of a number, bad for stocks. I mean, we're in a situation where it becomes really hard for risk assets to do well.
All right, we got to leave it there. Really appreciate you stopping by on your tour here of New York City. Alfonso Peccatiello, the Macro Compass. Back to you guys.
Thanks so much, Jared, and Macro Alf, as he is also known. Thanks, guys. Appreciate it. Well, coming up, we got the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. The closing looks poised to close just off the lows of the session. We'll be right back. There you have the closing bell on Wall Street. So let's do a quick check of the markets on what has been a negative session here. The Dow finishing down by more than 400 points, about 430 or 1 1/3%. The S&P 500 down about the same in percentage terms. The Nasdaq off by 1.9%. And if we look at the market internals today, I'm seeing consumer discretionary, real estate, information technology, and financials as the worst performing sectors. But all of the sectors in the S&P are in the red except for utilities, which, as we talked about a bit ago, they are having a bounce back. And as we know, one of the big motivating factors behind today's sell-off was the push up that we continue to see in bond yields, and that creating a ripple effect and all kinds of concerns about what higher borrowing costs are going to mean for consumers, not to mention companies within the market here.
Morgan Stanley slashing price targets and earnings estimates for cruise lines. This coming amid higher fuel costs and currency headwinds. Shares of Norwegian, Carnival, and Royal Caribbean all in the red. Though we should mention, Julie, I mean, some of these names have had some monster runs this year, too. They may be in the red, but just looking at Carnival, for example, it is up nearly 60% this year. And most analysts covering that name still think you should own it. But again, also there's a bigger idea that is the consumer, to the extent they get a little nervous. And we've even heard guests on today's show saying some believe that's going to happen. If you think that, then maybe consumer discretionary names could come under some pressure here.
Yeah, I mean, and two notes here. So you mentioned it's consumer discretionary names, which, as I said, is the worst performing group in the S&P 500 today. Cruise lines are part of the reason why. I think the question that is really coming to the foreign investors' minds now with a lot of these companies, how long is it going to last? You know, we have had the good times, as you mentioned, right? People have been traveling. People have continued to spend money. We talked to Kevin Mon of Henny and Walsh earlier in the show, and he was raising just that question, right? Are people's savings starting to work down? Are they going to continue to have a job, get a raise at the same rate, et cetera? And these are... no, it might be that it will continue. It's continued longer already than a lot of people expected. But these questions are really, one of the things.
And listen, it's why you're watching the labor market the way you are, right? Because at the end of the day, low unemployment, sub 4%, and strong wage gains. That's why you're waiting for any cracks in that market.
Yes, we're seeing a few cracks today. It feels like one of the other places we're seeing that manifest is in recently spun off companies. So far, and a lot of these spinoffs have been happening in just the past few days, right? So you've got Vestis Corporation, which was a spinoff from Aramark, the big food services company. This, I believe, is the apparel part of that. Veralto Corporation spun off from Danaher, and then WK Kellogg, of course, spinning off from Kellogg, which is now Kellanova. And so all of these, since we saw the spinoffs, have been underperforming. And, I think there are some specifics with these companies, but I think there is also just this broader, I don't want to take any risk in this market kind of attitude manifesting in the past few days.
Yeah, I think that's true. And also, listen, I mean, a company can make its case about why a spinoff makes sense. I mean, Kellogg can say, look, we're going to spin off Fruit Loops and it's going to get narrow and focused and not distracted by the Eggo waffles. That doesn't mean that the street or investors are necessarily going to buy it, or at least immediately.
Yeah, exactly. Maybe they wanted that growth that came with the snacks business that is not happening in the cereal business.
Yep.
We'll see what happens.
And finally, Eli Lilly to buy radiopharmaceutical company Point Biopharma Global for $1.4 billion. The acquisition aiming to expand Eli Lilly's oncology capabilities and next-generation radial gland therapies. And Eli Lilly, of course, Julie, has been on a tear this year. Of course, that's on the potential of weight loss drugs and Alzheimer's, but clearly building out this oncology portfolio as well.
Yeah, and we see Eli Lilly shares moving down. On a day like this, it's tough to suss out what's from this deal versus what's from the overall downdraft. I did see a little chatter on the part of analysts that at $12.50 per share, this is sort of the upper end of the price that analysts were expecting. So perhaps some questions over the premium that Eli Lilly is paying in this case, and that might be contributing to some of the drop in the shares. But again, on a day like this, when so much of the market is down, it's tough to.
There's a lot of cross currents. I will say folks are also pointing out that Fusion Pharmaceuticals surging today, and that's a peer to Point Biopharma. So maybe people are trying to sniff out the next target.
Yeah, they always do. That's the way it tends to work. Another company that we're watching today and a story we're following is Netflix, reportedly eyeing further price hikes for its ad-free platform following the conclusion of the actor strike, whenever that happens. According to the Wall Street Journal, the streamer is discussing hikes in several markets globally, but will likely begin with the United States and Canada. With more on this is Jamie Lumley, sector analyst at Third Bridge Group. Obviously, Jamie, we don't know when the strike is going to end, but what kind of pricing power do you think Netflix has?
Great question, and thanks for having me on today. As we look at the news today regarding whether or not Netflix will be raising these prices at the conclusion of the actors' strike, there are a couple things to keep in mind. One, if we just first look at as the why that they're doing this, on the backs of the writer's strike finishing, whenever the actors' strike finishes, Content prices will likely be more expensive as Netflix really thinks about their balance sheet, they think about their underlying profitability, find a way to really strengthen their position. Price hikes is one way to really do that. Another thing is just also something we've been hearing from our experts for a while now, and is the increasing value in driving people to the ad-supported tiers. Most of the ad-supported tiers for Netflix and competitors alike have not seen prices be shifted in the last year or so. So by raising the price on the ad-free, they're hoping they can drive further traffic there, as basically the underlying economics are increasingly attractive on the ad tier. When it comes to pricing pressure, certainly Netflix is often viewed as one of the leader in this industry, the early mover, the only profitable streaming company. So what they can command on pricing is definitely an interesting question. By and large, they are viewed as one of the key platforms by consumers to keep when they're looking through which platforms are worth their time, which ones are seeing high engagement, but necessarily how much that'll translate in their ability to raise prices from where they are now remains to be seen.
And Jamie, let's say they roll this out, they raise prices. Where do you think they would do that, Jamie? What geographies? I mean, do you think that would be US? Do you think it'd be Europe? Do you think it'd be both?
It's a good question. If we look at where they might do this, it might be good to draw some parallels to where they first experimented with the rollout of password sharing or the crackdown on password sharing, because what we've heard from our experts is Netflix is incredibly deliberate. When it rolls out something new, it tries to put in changes to make sure that this doesn't have any negative impacts in its most important markets. For the password sharing that initially had a crackdown in South America, and then in Canada before being rolled out in the US and other major markets. But for this, on the flip side, if this is an effective way, does not drive increased churn from Netflix, rolling it out in some of those larger markets will have the largest impact as Netflix looks to either further strengthen its positioning with increased content costs, or just to really see the most traffic driven to the ad-supported tier. They could very well try that in some of the larger markets like the US or Europe.
It's interesting. At the same time, we have Warner Brothers Discovery announcing an increase in price on its ad-free tier. You also have some reporting today that in Europe, Meta is testing out having people pay for an ad-free Instagram. So there's more competition from other places, right? Sort of non-traditional. Not that streaming is traditional, but even other places. So is that going to make things more difficult for the streaming platforms as well?
It's a good point. And really, if you look at how consumers have been reacting to overall price hikes, certainly one of the early promises for streaming was that this is going to be cheaper than the cable bundle. The first thing that people were looking to disrupt, to not have ads, to have something more a la carte, and overall have a cheaper entertainment spend, but more value as well for the type of content people are seeing. So if you look around to just the different ways people are spending their leisure time, certainly streaming continues to take share away from cable and broadcast, even while prices have been going up. But overall, the fight for people's attention is a competitive one. And again, just circling back to what Netflix is really looking at here, considering the profitability or just the contribution to the balance sheet of the ad-supported tier, they're really trying to drive traffic there, because as they get more people, that can help them command higher CPMs. They can experiment with ad load and have more personalized ads to really drive effective marketing there. And because of that, that can help them get away with some of this increase in pricing on the premium side, if they can still overall help scale parts of their business. If you look around to other parts of the media ecosystem, you highlight Meta and some of their plans there. Overall, it's TBD to see how consumers are going to react to things which they're used to perhaps getting free. But if there are people who are fed up with ads, they're thinking this is not necessarily what they want to be engaging with, that's when there could be a market for this, which is why these companies might pursue some of those moves.
And Jamie, Netflix is seen as a leader, obviously. So let's say they go ahead, they raise prices. Do you think there could be a kind of a domino effect there? Could that motivate other peers to do the same? Or do you think those other rivals have they've reached their ceiling of what they can kind of get away with on pricing?
So if we look across the industry, Netflix has not trailed others, but has been slower to enact price increases. Over the last year, Warner Brothers Discovery has had price hikes, Disney has had price hikes. The last Netflix price hike was the beginning of 2022. So it's been a while since they've tried to pass along higher costs to consumers. If we look at what's going to happen next, Netflix will certainly, again, be looking at potentially higher content costs, but they're also looking at overall reducing costs. Management beginning of this year said that the most intensive or cash-intensive 10 years of the company were behind them. They're moving forward to a new period for the company. So when it comes to, also looking at the other landscape, considering other players have already enacted price hikes, they may wait a little bit just because having too many price hikes together in one point, that could be challenging just from, a customer response standpoint. It might not necessarily be as effective from a churn standpoint as people look to see where their entertainment dollars are going. And also it's worth keeping in mind for a lot of these other players, if you think about a Disney or an Apple, for example, they started off at very, very low pricing at $4, $5, $6 a month. So considering that they're coming from a lower base, there has been more room for them to grow into to catch up to this pricing, but also means they have to be more cautious as although they may still be cheaper than, say, a Max or a Netflix, more price hikes are not going to make consumers happier. So a couple of things to keep in mind as they balance out how to get to an effective level of pricing to make sure they can drive profitability, but also not turn consumers away.
Jamie, thanks for always stopping by. That was Jamie Lumley from Third Bridge Group. Thank you.
Thanks for having me.
House Speaker Kevin McCarthy may be on his way to becoming the first speaker to lose the gavel. The final vote is underway to oust him as speaker. Here with more is Yahoo Finance's own Rick Newman. Rick.
Hey, guys.
Give us the latest on what you're hearing.
Yeah, as you said, the voting is underway. About 110 votes cast so far out of 435. It's a slow process. It's one person at a time. It's going to take a while. It won't be over the next 5 minutes. The betting seems to be that Kevin McCarthy is going to lose his job as speaker. So then what happens? Well, somebody else has to become speaker. Or, if you can believe this, McCarthy can actually win his job back if he loses it, because there are going to be ongoing rounds of voting for somebody to become Speaker of the House until somebody gets a majority of the votes. I mean, we know how this goes because there were something, I don't even remember the number, 17? Were there 17 rounds of votes in January the first time this happened? So this is unprecedented if McCarthy actually is removed. But the House does have to come up with somebody who's going to run the House. So that is going to be the question over the next few days if that's what happens. One of the interesting things to look for here, I mean, just to remind people how this works, to win the speakership, the member of Congress needs a simple majority. And those can be votes from both parties, but normally the minority party, in this case the Democrats, gives no votes to the Speaker of the House. So the majority party has to come up with something close to a unanimous vote if it has a small majority, as the Republicans do. It is possible that the next speaker could get the job with some Democratic votes, but that would require some concessions and some promises to Democrats on priorities that are important to them. So for people who fantasize about a more bipartisan operation in Congress, that is a possible scenario. I'm not sure that's a likely scenario, but it's a bit of a head scratcher if McCarthy does lose the job, who would actually become speaker.
And Rick, switching gears here, New York civil fraud trial against Donald Trump going on right now. That got underway this week, of course. I think Mr. Trump has called this a witch hunt. What do you think the knock-on effects, the consequences are, if any, Rick, for his campaign?
If there are no surprises, I don't think there are any knock-on effects. But I think that there are considerable chances that there could be some surprises, whether it's in this civil case or whether it's in one of the 4 criminal cases that will get started next year. I would point out that just today, Trump posted some snide, insulting remarks against a law clerk for the judge running this trial in New York. It's a female law clerk. Trump took that down, but the judge saw it. How could he miss it? And he has basically issued what is a partial gag order against Trump, which I think is, now that all these various trials are underway, I think is something we're going to see happening over and over again, because we know Trump just trashes everybody involved in the prosecution. So we have a real interesting question. what's going to happen when Trump violates a gag order? I mean, that seems like a very plausible thing that could happen. That is one wild card. There are many. Does he just pay fines? Is it possible some judge can say, okay, you won't stop. I'm going to put you in prison for a day. Who knows? Could any of this turn any of the Trump base against Trump? Who knows? But there are so many imponderables and wild cards in the 2024 election that you almost have to be ready to pay attention on a moment-by-moment basis here.
Imponderables and wild cards. We'll be watching. Rick Newman, thank you.
Hi, guys.
Coming up, shop till you drop. A new retail outlook predicts this holiday season will be a record for consumer spending. We'll break down how inflation might play into the numbers.
Got some breaking news now. Intel announcing it's going to be separating its programmable solutions group operations into a standalone business and then pursue an IPO of that business potentially here. This follows on, remember, it's separating out its Mobileye business and pursuing an IPO for that one as well. The share's trading about 2% higher in after-hours trading. This is going to be pretty quick. It's going to happen as of January 1st here that it's going to separate. And it looks like that Sandra Rivera, who's an executive vice president at Intel, will be CEO of this business once it's separated.
Yeah, I mean, when you look at CEO Pat Gelsinger, listen, he joined this company. There was real fanfare when he did join. He is a tested executive. He is a battle-tested technologist, an engineer's engineer, and he came in with the goal of sort of reviving this company, right? At a time where there is a ton of competition. He faces NVIDIA now, which is the poster child of the AI. But he's made some strong moves, and to try to win over investors, the stock has had a nice run this year. It looks like this is another one that he's going to make.
Yeah, I mean, I think investors would still argue that perhaps the results are mixed, or at least TBD, right? That Intel getting back into the foundry business, for example, with the push to build out some more fabrication here in the United States. So this perhaps, so the company can remain focused on those efforts. We're still kind of looking at what exactly is the strategy here behind this particular spinoff, if you will. This is the legacy Altera, I guess, that Intel bought years ago. That's like the core of this business that is now getting spun out. So We'll try to get some more context here and bring it to you when we have it.
All right, one to watch. And as we push into October, consumers are already thinking about their holiday shopping list. There are plenty of potential challenges, of course, for consumers right now, like rising energy prices, higher borrowing costs, the resumption of student loan payments. But one estimate sees holiday spending poised to surge to its highest level ever. PwC releasing its 2023 holiday outlook, which shows almost 40% of consumers plan to spend more this year than they did last year. For more on this, we turn to PwC U.S. retail leader Kelly Pedersen. So Kelly, talk to us about your survey and the trends you see this holidays.
Yeah, sure. Thanks for having me. Yeah, we were pleasantly surprised to see the confidence in the consumers this holiday season coming into it as part of the survey. So overall, their planned spending was up 7% compared to a year ago. We run the same survey every year. It was about flat to the previous year. So a really nice, healthy increase. I mean, there's some different stories once you start peeling back the onion in terms of demographics. As well as what they're spending it on, but overall, I think it's a good sign for the retail environment.
Kelly, how much of this, and I don't even know if we can sort of tease this out, how much of this is because of higher prices versus people actually buying more things?
Yeah, it's a good question, and I think overall, as I mentioned, the 7% increase in spending on holiday, and we break that out into three different areas. So we have gifts, entertainment, and travel. So I can tell you both gifts and entertainment, which are the areas that are likely the most affected by inflation, are up about 4% on last year versus travel is up 12%. So we're really seeing it, as a year of people getting out there and traveling for the holidays in relatively big numbers. So if you think about our average inflation rate, I think last month it was close to that 4%, right? So we think about both gifts and entertainment increases at 4%. I think that's also consistent with a lot of the retailers we work with. Is many are seeing some moderate sales increases, but most are not seeing an increase in the amount of units or the things that people are buying. And so I think it's consistent with what we're seeing. It's really higher prices that are carrying on into the economy.
And Kelly, who's doing the spending? When you do your survey work, is it men, women, young, old? What are the demographics?
Yeah, there's a couple of really interesting ones that came out. So I think one is you talk about men versus women. We ask the same questions every year, and for the most part, men and women have similar increases or are very in line with each other, maybe a couple of percentage off. This year we actually found women are spending a lot more than they did the previous year. So they were up 11% versus men were in the lower single digits. And so we're actually finding an interesting demographic shift in mindset this year. I think it's some speculation to what it could be. And a lot of people are calling this, the summer of the female between movies and concerts and things that are out there. But there definitely seems to be a lot of optimism, especially for female shoppers heading into the holiday season, which also has a lot of implications for businesses and retailers and how they think about it, because women inherently shop differently and prioritize some different things than men do. And then I think, to your question on, age demographics as well. Again, another really interesting story we're seeing out here is we found the Gen Z population, so those up to 17 to 25, up to 25 years old, saw the highest planned spend. So that was up 15%. Compared to baby boomers who are actually planning to spend 4% less this year than they did last year. So we're seeing this movement towards a younger generation of shoppers, and their willingness to spend more on the holiday season.
Well, and you also found that they're willing to spend more actually in physical stores, which is interesting. And it's especially interesting, Kelly, given some of the news headlines we've gotten as of late. On the one hand, we have Target that has been closing some of its urban locations in part because of safety issues and theft at those stores. And the other, we got Macy's, which says it's going to be opening 30 smaller footprint stores, more not in the traditional malls, but more in like strip malls, right? That might be seeing more traffic right now. So when you're speaking to retail clients right now, what are you telling them, or how is their thinking changing on this whole store footprint issue?
Yeah, so we found that more and more, and a lot of retailers are seeing an increased footfall or foot traffic into stores. And and it's consistent with our survey results, and the younger generations actually like to go in stores really to finish the transaction, right? We ask them where they transact and where they interact with retailers at different parts of their journey. And a lot of the discovery and research and even some customer service type of inquiries are done digitally. But we find more than any other demographic, believe it or not, more than average, is Gen Zs like to transact in store. They like to go to the store and they like to buy things there. Some have speculated that it's kind of a return to the social, the social environment that was shopping that many of us grew up with that kind of disappeared for the last 10 or 15 years. People are coming back, but we also know that, to your point, about some of the other retailers, how they're thinking about their footprints, they're not going back to the traditional mall format. They're going back to more of, a high street type of format where you have, stores in shopping areas and you're really, you're really kind of socializing around those aspects. And so, yeah, we've definitely found, it is important for retailers, and we often talk about that, how, many years ago, people were saying at some point the physical store is going to be dead. Well, it's not there. In fact, the younger generations are proving that completely wrong, because they really like to be in that social environment of being helped in a store.
Very interesting stuff. Kelly Peterson of PwC, thank you. Appreciate it.
Thank you.
Maybe one of the places people are going in those strip malls are Chipotle's. More robots are coming to Chipotle, and one could even assemble your burrito bowl in the future. Yahoo Finance's Brooke DePalma has the details for us. Brooke, of course, first it was Chippy, the chip-making robot. Now we got bowl-making robots? Tell us what's going on.
That's right, Julie. I mean, Chipotle continues to invest in automation, and we continue to be wowed by just the automation and the innovation that's really coming from this burrito chain turned automation center. I mean, this is just the latest investment that Chipotle has made in order to increase its throughput during rush hour to fulfill digital orders. This is in partnership with the food service platform Hyphen that Chipotle invested in last year as part of its $50 million venture fund, Cultivate Next. So here's how the digital assembly line works. On the top line, you could see there an employee fulfills part of the digital order. So think things like burritos, tacos, quesadillas, and then underneath the digital make line will assemble salads and burrito bowls by positioning the bowl under each ingredient and then fulfilling the exact amount that the customer ordered. Now, one of the biggest challenges, one of the biggest hurdles that Chipotle had to go over while creating this digital make line was making sure that each ingredient was portioned correctly in order to ensure that if a customer ordered 3 different types of salsas, well, it wasn't too saucy. Now, we know, as you mentioned earlier, that this is just one of the many investments in automation that Chipotle has made. As you mentioned, they have Avocado, they have Chippy. But now the question is, how many of these digital technologies, these automations are going to be in one restaurant at a time, whether or not they'll be at separate restaurants? But their chief technology officer did mention that this particular assembly line is still months away from actually being introduced into a restaurant. And he said that no matter how many automation parts are being introduced, the employee is still at the core of Chipotle's business, saying, quote, the best solutions for restaurants and guests are those that have a co-pilot or are probiotic in nature. And so consumers, well, don't expect to see a fully automatic Chipotle or automation-wise Chipotle in the near future. They plan to keep labor at the forefront of the stores as well.
And Brooke, how does this play into Chipotle's long-term strategy, and what's the street saying?
Yeah, well, Josh, I guess you could say that the digital wave and automation is certainly at the forefront for fast food and fast casual restaurants. And we know that digital sales continue to be a core part of food and beverage revenue for Chipotle. Last quarter, it was roughly 38% of digital sales that made up that total food and beverage revenue. And that continues to hold steady post-pandemic. And, really, when you think about how exactly Chipotle wants to deploy its labor are in both the front line, where people are fulfilling orders for those people that come into store, for those customers, and then also make sure that they're keeping up with that inflow of digital orders. They're getting more smart. They're building this technology in order to meet that demand. But, this comes at a cost. And so when I spoke to one analyst on the street, Morningstar analyst Sean Dunlap, he said, quote, there's certainly a lot of potential for automation in the restaurant space. But the issue that you run into is a lot of this equipment is really expensive. And so it'll be interesting to see, while all this investment in automation is certainly exciting for consumers and getting a lot of attention and a lot of buzz, it's important to whether or not to see this fully deploy out to every single restaurant, or how they'll pick and choose where this goes. And, we're seeing other fast casual restaurants certainly weigh into this. Recently, we saw Sweetgreen invest in an automated production line, and they're seeing big returns there as well. And so I'm sure Chipotle is looking out to see what the competition is doing as well.
I'm sure they are. Brooke DePalma, thank you. Coming up, we're going to go around the horn with today's top stories, including the Fed joining Instagram. That's next.
Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Prod Supermanian. We are going around the horn with some of our favorite stories of the day, some stories that caught our eye. And guys, there was one thing out there on Instagram today that I just couldn't get enough of. I want to play you guys a clip right here.
Hi, I'm Jay Powell. I'm the chair of the Federal Reserve. And I want you to know that the Federal Reserve is now on Instagram and Threads. The Fed is America's central bank, working to promote a healthy economy and a strong financial system. That mission starts with you. October is National Economic Education Month, and throughout the month and beyond, we'll be posting here with information, links to events, and other resources about how Fed decisions affect you, your family, and your community.
There you have it. The Federal Reserve on Instagram. Jerome Powell making an appearance. Yeah. I loved it. I thought it was funny.
I think it's so smart. I mean, Instagram, social media, you want to appeal to a younger consumer. And let's be honest, if you're not in this line of work, if you're not tuned into what's going on and you're on the younger side, you probably don't understand how these decisions affect you, but they really do. And I think the fact that they're trying to make it more accessible is a good thing.
I wonder what level of accessibility we're going to talk about when we talk about videos here, because when you think about their presence on X, formerly Twitter now, they have over 1 million followers, but a lot of it is just releasing their press releases, right? And X is a place where people get news. I know we talk a lot about Instagram being a place where younger people get news, but do they really get monetary policy news on Instagram? Pras, you want to be scrolling and hearing about monetary policy and interest rates? I don't know.
See my guy Jay, no tie there. He's trying to go where the people are at, trying to speak.
He took the purple tie off.
Speak to them like as if they're just hanging out in your living room. Look, I think he's going there because he understands that. I think people are sort of, they want to want explanations. Why are rates going up? Why are things expensive? Is this your fault? Is this why my car payment's going up? My credit card bill? Like, I think they have to go there and address these things to the real people because they're upset, I think, potentially about some of these decisions, especially high rates.
Yeah, it feels like now more than ever, we're talking about the Fed. Even in my friend group, people that don't normally, talk about this stuff, it's in the dialogue, it's in the conversation.
It's a fun dinner.
Well, it's just affecting everyday life. You totally talk to about the Fed with your friends.
Depends on who the friends are.
100%. This guy.
Hey, look, I cover markets for a living, right? So let's talk about the Fed,
It depends on who the friends are. But I think you guys are getting to a point that you're already starting to see on the Instagram. I was curious. I looked at the comments a little bit.
My favorite thing to do on social media.
You have people already complaining about why higher for longer? What's going on? Like people are actually using the Fed terms in the comments and complaining.
They should do
you got
ask me anything. Ask me anything with Jay Powell. I love that idea.
But I gotta say, Joel stated today, right? We might have to adjust our monetary policy. What, more higher rates because there's more job openings? People are getting paid more?
Economic good news isn't always good news, Pras.
Pras has been waiting to talk about the JOLTS data.
Pras really just wanted to talk about JOLTS, and he has to talk about the Fed on Instagram instead, so you had to bring it in.
All right. We moving on here?
Yeah.
Okay. Well, let us stay with the world of social media. How about this? I got a line here. Going ad-free for IG? That's good, right? That's good, right? Anyway,
I love it.
The Wall Street Journal, sorry about that, guys. The Wall Street Journal reporting that the EU, Meta in the EU looking at potentially adding a $14 or so fee to access those products without ads. This is a way to sort of go around the opt-in nature of the personalized ads they have in Europe, where you have to actually opt in for these things. So they're saying, you know what we offer someone a ability to pay for these, to pay for an ad-free feature. So they want to do that for the mobile. See, $14-ish for mobile apps there. I'm not sure I would do it. I think I'm too cheap.
$14 is laughably high.
Yeah.
There is a 0%.
Yes.
Legitimately 0% chance I would pay $14 for
Meta
eliminated advertisements.
doesn't want to do this. Like Mark Zuckerberg, he's historically said, I don't want to do a subscription-based model. We make our money on ads. So if you're dealing with regulators that are saying you can't do that, I think it's smart to be like, all right, well then we're going to charge people because there's no other way to do it.
That's fair. If they're not, I understand
Europe,
that part of it.
Yeah.
In Europe, like this is Europe.
I would also say, just talking about having to pay, I'd be more inclined to pay a couple bucks to get the targeted ads.
I know.
I'm terrible at shopping.
I
shop on Instagram all the time. I like Instagram targeted ads.
What's the big deal with like
They're great.
personalized ads? I'd rather see personalized
I'll pay
ads.
you. They do my shopping for me. They tell me what I like. It's awesome.
No, it is true. I'd rather have personalized ads than random ads. I know you guys look at creatine all the time. Images there. I don't want to see that. I don't want creatine.
I want Instagram to tell me what protein I need. But seriously,
want a backpack.
They do a great job with it. If you combine that with free shipping or something, then you're just talking about a great shopping product. And that's part of what Instagram is.
I want to touch on what you said, Ali, is that Mark Zuckerberg said, I want it to be free to get the most people. I don't want people to pay for this.
Right.
But because of what's going on, and because it's $14, they have to pay Apple a cut and Google a cut for the store. So it's almost like you're just adding on more and more, tagging on more fees. Who's going to pay $14 a month?
That's the thing. People don't want to pay that. Especially, I feel like we're all desensitized to the ad experience right now. Especially for me with Instagram, even Snapchat, all these services. I am fine with watching.
I don't follow enough interesting people on Instagram to not have ads. What would I do without the ads?
Do you think Zuckerberg knows that people will say, you know what? I'll just opt in for the ads. You know?
Yeah.
Forget the $14. I'll just opt into the ads. Why not?
I think so. But so, maybe in the EU, Meta might not be free, but over here in the United States, something is free today. And that is the Mean Girls movie. You can watch the entire Mean Girls movie on TikTok. This is what Paramount is choosing to release. And why? Because it is October 3rd. And that is the iconic date from Mean Girls. Look, it's in 23 parts. This movie's an hour and 47 minutes long. The fact that they were able to even put this entire movie in these clips on TikTok is pretty remarkable. I don't know personally if I would sit there on my phone
watch a movie
and
in
watch
vertical
clips
on your phone? No,
in
thank
several
you.
clips. Yeah, it's not for me, but certainly got people talking. Look at the likes too. A lot of likes.
Now, all right. I'm normally so negative, so I'll be positive about this one.
Wow.
One thing.
Wait, you wore your pink.
I wore pink.
For October 3rd?
Yes, I did.
He knows a lot of
It's
it.
not Wednesday. I know on Wednesdays we wear pink, but I also knew, I played into it a little bit.
I'll let it slide. Mean Girls
But
Day.
I will say, part of how I got into Suits, we've talked about how I was in on the resurgence of Suits on Netflix.
Yep.
I saw clips on TikTok.
Oh.
And it interested me because you can watch full scenes, right? And it's kind of like a teaser. So the fact that Paramount's doing that
So maybe that is
really
why they're
interesting
doing it.
here. Because no one's going to watch the whole movie. It's not the point, right?
But
They
it
want
does
you to
put it
see.
back
They
in
want you
your
to see some sort of scene of Regina George and then say, okay, I want to get in or get back in because of that. It's not really about watching the whole movie, I think.
Okay, I like that take.
I'm waiting for Citizen Kane to go on.
Citizen Kane.
To go on TikTok.
What is that?
What movie is that? The #1 movie you'd want to see on TikTok?
Well, I mean, I'm kidding, but it's it's like a 3-hour Orson Welles movie about the media world.
But like the Irishman.
Yeah, Irishman's
Netflix.
like that.
That on TikTok.
Every Godfather.
Part 2. Part 2.
Maybe, I don't know. Maybe this is a new trend that we'll have to watch. I don't know. But maybe I will be.
Maybe.
Yeah, maybe that's a thing. Who knows? Well, I'm excited. Josh is in his pink. We're going to be watching the Mean Girls movie on TikTok, and hopefully you're still watching us because we have much more Yahoo Finance on the other side of this break. Stay tuned.
All three major averages closing lower on Tuesday. Wall Street selling off thanks to rising Treasury yields and a reminder not to expect a Federal Reserve interest rate cut perhaps anytime soon. The S&P 500 at a 4-month low. Comments by Fed policymakers that were read as hawkish reminded investors that resilience in the U.S. economy likely means that borrowing costs will stay higher for longer. For more on the markets, it's my pleasure to invite in Lizanne Saunders, Chief Investment Strategist at Charles Schwab. Lizanne, it's great to see you. So we had this big sell-off today. We have yields continuing to push higher. It feels like even after the bad September that we had, that maybe there is still downside here. How should investors be thinking about this?
I think it is a continued momentum in Treasury yields that has certainly stretched well beyond even those on the more sort of pessimistic end of the spectrum as it relates to yields. And it's been part of, obviously, the trifecta of what have been the spike in bond yields, the rising dollar, and until very recently, the move up in oil prices. And it just, I think when you saw that spike go beyond technical levels in the 10-year, it just added to pressure on the downside. And admittedly, though, the rally that preceded it was healthy at the index level, but was very narrow, as we all know. The sell-off has been much broader, and at least as of today, not over yet.
And Lizanne, what does this mean for the consumer as well? You know, the consumer has proven very resilient thanks to that labor market. The consumer's been hanging in there, but now these spikes in rates, in oil, the dollar, what do you see your outlook for the consumer, Lizanne? You think continues to prove resilient or some cracks forming?
I think there are some cracks forming. Yes, you did see a revision to savings rate with the comprehensive BEA revisions to overall GDP data, suggesting that there was more sort of excess savings and liquidity that could fund consumption. But we're getting close to the point where that starts to get exhausted. And I also think you can't look at the consumer monolithically anymore. You've got to start to look at income brackets in terms of where pressures are becoming more acute as it relates to the rise in yields. Look at what's going on in things like delinquencies and defaults, particularly, as is usually the case, starting in the subprime category, but then you start to see it move into the upper income categories. You add into the mix the fact that student loan payments are kicking back in. You already mentioned the pressures associated with oil. I think in general, there's been more resilience to the rise in yields because both on the consumer side of the spectrum and the corporate side of the spectrum, a lot of people termed out, they improved their balance sheet, they moved to fixed rate financing from variable rate financing. So that helps to explain why maybe the lags between what the Fed has done and impact on the economy has been longer. I just don't think we're past the expiration date in terms of when they start to show up. And if the labor market weakens further from here, that has been, I think, an important underpinning for that consumer strength, which could start to fade more acutely.
Well, and now it feels like the equity market is anticipating that lag to start to catch up, right? You know, you're one of the best chart watchers out there. What signs are you looking for that these declines might be coming to a close? Or, you know, are we headed to 5% on the 10-year, for example, and further declines in stocks?
So I think momentum is such that, yeah, we could get to 5% on the 10-year. We just had an internal conversation about that today with my colleague, who you know, Kathy Jones, who's our fixed income strategist. You know, all the move up in the yield has been the term premium. It's not been a renewed concern about inflation via inflation expectations, but momentum can pull things in one direction for a while. In terms of what to keep an eye on, it would be those breadth conditions. So we have to remember that a year ago in October, the indexes were taking out their prior lows, which had been in June, but under the surface, breadth was improving. So that's a positive divergence in sort of technical jargon. That's what I'd be looking for, is even if the indexes continue to behave poorly, if you start to see under the surface an improvement in breadth, you know, more of the soldiers marching to the front line versus just the generals, that would be the kind of positive divergence, positive sign that we saw back in October that laid the groundwork for the rally that we got. So breadth statistics, I think, are really important to keep an eye on at this point in the cycle.
Yeah, and to your point, the breadth on the downside has been more negative, right? More broadly negative. Right. Lizanne, I want to bring you some headlines that we are just getting because there could be some market implications here, and it has to do with Kevin McCarthy, who now, in a vote, has just been ousted as the Speaker of the House in a 216 2-210 vote. We don't yet know who might be there to replace him as Speaker of the House of Representatives. But obviously the result of a sort of hardline Republican revolt against the Speaker, and then the Democrats also voting to oust him. Lizanne, we just averted a shutdown for now. Now this is happening. How should investors be thinking about D.C. right now?
Well, to the extent you think, oh boy, this is brand new chaos, I'd love to know what lovely rock you've been living under, because this has been, DC stuff has been pretty chaotic for a while. But, it not only adds to the uncertainty mix, but I think part of what's been going on in the bond market is the bond market is, I think, sort of punishing profligacy and the lack of attention to things like the high and rising burden of debt and the ability to finance our debt. And you could kind of put this as part and parcel with kind of Washington dysfunction. And what we don't know yet is how quickly at least an interim speaker will be named, because in advance of that, nothing really can get done. So I'm not going to speculate on who that might be or when, either a temporary solution or permanent. This is all just happening now. But it doesn't make the situation better. That's the ultimate statement of duh.
Lizanne Saunders, Charles Schwab, Chief Investment Strategist. Lizanne, thank you so much for your time.
My pleasure. Thanks.
Well, breaking news now. House Speaker Kevin McCarthy, as we just told you moments ago, ousted from his role. The vote just wrapping up, and Yahoo Finance senior columnist Rick Newman is here. This seemed not necessarily likely or thinkable just a few days ago, Rick, and now it's happened here. 216 to 210, Kevin McCarthy no longer Speaker of the House.
Well, it's never happened before in U.S. history. I mean, we've never had a speaker removed, and let's remind everybody, removed by his own party or by a small sort of rump faction within his own party. So the obvious question is what happens next? And this doesn't mean McCarthy is finished. I mean, basically, we start over in the bid to elect a House Speaker, and the House is going to have to stay in session until they have a Speaker. So McCarthy can basically try again, which is what he did the first time around when I think we had 17 rounds of votes. He couldn't get to the majority vote threshold for several days, but he finally got there. And so people might say, well, what would change between now and then? Well, McCarthy has to find. I think there were 8 Republicans basically who voted against him here, and that was enough because all Democrats also voted against him. So McCarthy could just try to do some deal making with some of those 8 holdouts, and I think he would need to convert either 3 or 4 of them. So what could he give them, in terms of projects for their districts or committee seats or something like that? Another interesting possibility, we briefly got to this earlier in the hour, but McCarthy or somebody could form an alliance with Democrats. I mean, remember, Democrats have almost a majority in the House, and if you got most of the Democrats and some Republicans voting for a candidate, that person could become Speaker. Now, there would be, more chaos in the Republican Party, I guess. But that's another way this could go. And I'm sure there are some possibilities that the supercomputers haven't yet been able to figure out. But this is a weird and literally unprecedented situation. So welcome to more chaos in Washington.
Fun stuff. As Lizanne Saunders said, you'd have to be living under a rock to think that this is new chaos. There's just new flavors, I suppose, of the chaos, Rick. I'm seeing reports here that the interim speaker for right now is Patrick McHenry. So he has recessed the House. So both sides can sort of figure out what the heck to do now. When you talk about McCarthy potentially allying with Democrats as one of the possibilities here, I mean, he just has said in the past 24 hours that he would not do that. And that seems to have cost him, at least one of the reasons it's cost him his speakership. His party is also trying to impeach the sitting president. So throw that into the mix as well here when you try and figure out, could there be some kind of alliance?
Right. I mean, this is why I say it takes a supercomputer sort of figure out all the different directions this could go. So let's say there were some kind of deal between McCarthy or somebody else who would have to be a fairly moderate Republican, certainly not one of the batwing Republicans that have thrown this whole thing into chaos. If they were to try to make a deal with Democrats, I mean, I think one of the first things Democrats would say is, well, one of our conditions is shut down the Biden impeachment inquiry. They also want more. They want to get through a bill that provides $24 billion, if not more, in aid for Ukraine. And I'm sure there's a long wish list of things the Democrats would say, well, here's what we want. Now, even moderate Republicans probably wouldn't go along with that. So I don't know how this is going to shake out. And all the political analysts I follow are all scratching their heads. One thing I will say is, guess who ends up looking pretty good in all of this? President Biden. And in fact, Democrats themselves actually look pretty good. Democrats basically don't have this type of civil war happening that throws the whole Congress into an unworkable situation when they're in control. And President Biden, the Biden White House keeps sending out what they call these split screen analyses saying, well, here's what the clown Republicans are doing. And here's what President Biden is doing. He's working to fix the border problem. He's meeting with foreign leaders. He's doing all this serious stuff, whereas these Republicans are just having a food fight among themselves. So there's some potential traction for Biden and Democrats here with regard to the next election, as long as they can sort of keep reminding voters of this. And if Republicans keep doing this, keep shooting themselves in the foot, of course, that's good for Democrats.
It is interesting, just on that point, Rick, while you were talking, I'm seeing this statement from House Minority Leader Hakeem Jeffries, Democrat from New York, and he put out a statement that he and other Democratic leaders would vote yes on Congressman Gates' motion to oust McCarthy. And he says here, it is now the responsibility of the GOP members to end the House Republican civil war. So I guess, Rick, that kind of speaks to your point here, how Democrats feel when they sort of watch McCarthy and the GOP and House members kind of twisting in the wind here.
I mean, simple rule of politics. When your opponent is screwing up, get out of the way. And that's all Democrats have to do here. Let's remind everybody, this deal to keep the government funded only was only for 7 weeks. So we're going to get to the middle of November and we're going to face a shutdown situation all over again. And we're going to have to figure out whether Congress can pass the normal bills that they, for the most part, have always passed that just keep the government working. So we are going to have a speaker by then, but will this situation with basically, 5 or 10 extreme Republicans holding the whole rest of the government hostage, are we going to be able to get past that? Or are we just going to have a replay of that in November? I don't think anybody knows.
They don't know, and that uncertainty also seems to be weighing on stocks. Even after the tough session that we had, it looks like futures are pushing lower, but we'll see how this all shakes out as we head through the morning and the next few weeks, the next couple months, figure out what's going to happen here. Rick Newman, thank you so much for breaking all of that down for us.
Bye again.
Bye again. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 to 5 p.m. Eastern, for all of your coverage leading up to the close. We'll see what more surprises await us tomorrow. Take care.